Hey guys, welcome to Investify, where we help you grow your wealth through smart investments. Today, it's all about Sofi Technologies and Palantir Technologies. We're set to analyze why I'm absolutely loving Sofi stock, and trust me, you should be excited too. Plus, get ready for a double dose of insights as we not only dissect Sofi's performance, but also drop a bold prediction about Palantir's Q2 earnings report. So fasten your seatbelts as we unpack the and wisdom that could steer your investment strategies. Sofi Technologies is a big player in the financial technology world, providing all sorts of financial services. On the other hand, we've got Palantir Technologies, which is all about using smart software to help companies analyze data and make smarter decisions. So whether you're into finance or data crunching, these two companies have something interesting going on. Let's delve into Sofi, a fintech sensation making waves. This finance-focused tech giant known as social finance dominates personal finance management. From student loan refinancing to mortgages and trading, Sofi's integrated digital platform offers diverse services. Trading around $10 per share, Sofi Technologies triggers varying predictions. Bearish views anticipate a drop to $3, while bullish perspectives foresee a rise to $16 within a year. Remember, accurate predictions remain elusive, despite analyst opinions like Jim Cramer's. Fintech trends and Sofi's fundamentals provide insights, but treat price projections as informed guides, not certainties. Sofi's rise is attributed to its comprehensive digital services spanning banking, trading, and more. Though options differ, selling Sofi might not align with long-term investors. Despite a buy rating from 7 analysts, note the average one-year price forecast at $16, slightly under the current price. Challenges exist in the financial services and tech segments, with potential profitability requiring time. Losses in financial services have dropped and tech contributes a fraction of revenue, growing at 4% annually. The CEO envisions these segments synergizing, possibly reaching profitability by Q4 of 2023. Sofi Technologies' diversified revenue approach is strategic, although some segments currently weigh down the company. Patience is crucial as financial services and tech platforms mature, enhancing future profitability. Consider Sofi a long-term investment, holding it with patience. While you hold Sofi Technologies, don't invest over 5% of your initial portfolio in a single high-growth company. Looking ahead, Sofi Technologies seems promising. With the expected ease in interest rates, economic strength will reflect in financial markets, benefiting Sofi's model. Their flywheel strategy should drive growth and profit, especially post-2023. While slightly overpriced, Sofi's potential shines over the long term, ideal for 5 to 10-year investment. Explore similar spaces like New Holdings, Mercado Libre, and Ally Financial. Ultimately, Sofi Technologies remains robust and well-positioned for expansion. But the real question is, how's the stock doing? Let's delve into the data. Sofi's stock has seen its fair share of volatility since its IPO. With a strong focus on innovation and user-centric offerings, Sofi managed to pull in a solid customer base. Plus, their recent acquisition of a bank charter has expanded their horizons even further. Now let's turn our attention to a daring forecast for Palantir's Q2 earnings report. Known for its data analytics prowess, Palantir often surprises the market. With involvement in various sectors, from government contracts to commercial collaborations, there's heightened anticipation for their impending earnings release. Here's the bold assertion. We're anticipating Palantir to exceed Q2 revenue expectations. Why? Their diverse client base and proven ability to provide data-driven insights in our data-hungry world. Palantir's performance could serve as a barometer for how data analytics companies navigate the ever-evolving landscape. Let's pivot to what brought you here. Palantir Technologies. We're poised to unravel their Q2 revenue forecast, which is why I'm inclined to believe they'll outshine expectations. Currently trading at $18 per share under the ticket PLTR, Palantir specializes in big data and analytics, catering to both commercial and government clients. Their adeptness in artificial intelligence has played a part in propelling their share price. As we approach their Q2 2023 earnings reported August 7th, market sentiment will significantly influence their stock's trajectory. Specifically, our focus is on their revenue, and to comprehend it fully, we must consider broader market dynamics. Before we continue, don't forget to give this video a big thumbs up, subscribe to our channel, and ring that notification bell for more updates. In the previous quarter, businesses globally scaled back on discretionary spending due to the uncertain economic climate, opting for fiscal caution. Palantir's technology, known for its costliness, felt the repercussion of this trend. As the world braced for a potential economic downturn, companies turned conservative, resulting in diminished sales and growth for software and analytics firms like Palantir Technologies. Businesses are gradually ramping up spending, particularly as Palantir introduces AI analytics and AIP to their platforms, fueling revenue growth, especially on the commercial front. With the growing significance of artificial intelligence in the business world, spending on Palantir's products is poised to rise, potentially leading to substantial contracts. Delving into their segmented finances, Palantir categorizes revenue into commercial and government spheres. While operating in both B2B and B2G capacities, the growth rate of their business-to-business segment is outpacing the business-to-government side, validating our earlier predictions. Palantir's commercial revenue has shown consistent growth, even during the recession, a phase we've likely moved beyond. With economic recovery and intensified direct sales efforts, Palantir's top-line performance is likely to strengthen. As new AI platforms unfold, businesses are resuming spending to stay competitive in the AI sector, further boosting Palantir's commercial revenue in the years ahead. Additionally, if the Federal Reserve reduces interest rates to manage inflation, an augmented money supply could benefit Palantir's commercial endeavors. However, the government sector, which ensures stable revenue, is displaying signs of saturation and slower growth. Combining these segments, I state Palantir could generate around $550.4 million in revenue, surpassing Wall Street's estimate. Considering these factors, my optimism remains high that Palantir will exceed revenue expectations in their upcoming earnings report. That wraps up our dual exploration of Sofi Stock Analysis and our daring prediction for Palantir's upcoming Q2 earnings. Always remember, the stock market is a dynamic realm and surprises are its hallmark. Anticipated to rake in approximately $530 million in overall revenues, even a $1 million overachievement would signify a revenue beat. The author's projection leans towards an impressive beat of around $20 million, underscoring Palantir's strong stance to outperform analyst projections in their imminent earnings report. Such optimism is poised to propel momentum and boost share price growth. Nevertheless, taking a page from Sofi Technologies' playbook, a post-earnings pullback might follow the initial uptick. It's vital to acknowledge that Palantir's stock carries a notable premium, trading over 21 times its trailing 12-month sales. A valuation considered steep. Ideally, a more favorable range would be closer to or below 10. Speaking of favorable metrics, a desirable buying opportunity would materialize with a price-to-sales or PS ratio of 10 or below. The author emphasizes that comparing Palantir's current PS ratio to historical peaks might not be the most accurate gauge, as those instances involved inflated valuations. Instead, the wiser benchmark is the industry average, which is significantly lower than Palantir's present ratio. This implies the company's shares are trading at a premium. The prudent strategy, especially for long-term investors, is to hold steady through earnings, capturing gains at the zenith and reinvesting during pullbacks. The key is a strategic long-haul perspective that transcends the ebb and flow of imminent earnings. That's it for today. Thank you for watching. Don't forget to like this video, subscribe to our channel, and ring that notification bell for more updates here on Investify.